Hello, everybody. My name is Josh Johnson. Welcome to the Georgia College Student Managed Investment Committee instructional guide videos. And so today we're going to be covering two models, the discounted net income model and the residual income model. And so just as a sort of heads up or disclaimer, if you have not gone through and read the actual valuation or instructional guide itself, before you get to this video or any other videos, I would stop and go ahead and work through those, read that guide, at least for the model that you're working through the video for, because there's going to be a lot of conceptual topics that we're just not going to be able to hit on in the videos and the depth that you need to understand them. So, without those conceptual understandings that gets hit on in the guide itself, that you need to read about and really get an understanding of, you're not going to be able to effectively work in Excel and complete these models, much less interpret them and be able to get meaningful results. And so one of the reasons is specific for this actual model. And so I'm actually going to hit on that in this little intro. So for the discounted net income and residual income models, the reason we're doing them together is because typically you want to do both of those models together in conjunction with one another. You don't want to look at one of these models without the other for a single company, right? One of them is a lot more conservative than the other. So if you're to just look at that one model, residual income model, you might think, oh, this company is way overvalued. We shouldn't even bother with it. Whereas if you look at the other one, you might think, oh, this company's way undervalued. We should for sure buy this one over another company. When in reality, that might not be the case when you look at the two together and you complement those two together. Additionally, these two models are typically used for financial services companies like banks and insurance companies because using a traditional DCF typically it isn't the best. It's not easy to calculate free cash flow for these types of companies, which is what you need to do in order to complete a discounted cash flow. And again, these reasons get more in depth of why you can't calculate free cash flow in the valuation model itself. So today we're going to be looking at the company JP Morgan. So again, a bank, a huge bank, huge financial services company. So without further ado, we can go ahead and pull up the model. All right. So now we have the model pulled up. So when you pull up the model, you're going to see the cover page right here. So this is what the cover page should look like. And then as you move through the model, you're going to see the first tab here. It's going to be the net income projections. So this is where we're going to project net income from 2020 actual all the way through 2028 estimated, so forecasted. We're going to go to the D&I tab, which is where we're going to take those figures and discount the figures back. And then finally, we have our capital asset pricing model tab, and that's already filled out. And I'll explain that in a little bit, why that's already filled out. But when you come in, the first step to completing a discounted net income is to pull net income into the model, hence the name. So that's going to be step number one, is pulling net income into the model. So for that, you need to have the income statement readily available. So you can pull this obviously from sources like Bloomberg, Yahoo Finance, routers, anything like that. So I have this from Bloomberg. Bloomberg's typically the easiest source because you can download it directly to Excel. So what we're going to do is we're going to go back in here, and to pull net income into 2020, you're going to go into the 2020 cell right there and click equals, and then go down to the income statement tab. Then for net income, you're going to go down to the bottom and find net income. And when you get down there, you're just going to click enter, and it'll automatically pull that number for you. And so as you can see here, I use the number net income GAAP. And then from there, a little handy trick that you'll probably see me use in some of the other videos is you can pull this formula. So you can select this cell and then select the cells also to the right of it, and then hold Control R, and this is typically only going to work on a PC or a Windows computer, but I believe Command R might be the shortcut for that on a Mac. And so it'll pull that formula to the right. So then for 2021, it's going to pull that number. And then for 2022, it's going to pull that number and that number for each respective year. So it's very easy. You don't have to just keep going in and finding those numbers. And so now, obviously, there's not numbers for 2024 yet, 2025, 6, 7, or 8. So how are we going to find that? Well, typically, what you do is you project net income as a percentage of revenue. So net income, each year is going to make up a different proportion of the revenue a company earns, the sales that a company generates. And so in order to do that, we're going to have to pull revenue from that income statement. So again, let's do kind of the same thing. Go up here to net revenue and pull 2020 for net revenue. And then you can Control R and do the same thing, or Command R for Mac. And then you want to do the same exact thing for 2019. Because we're going to have to find a growth rate for our revenue growth, right? So that's essentially what we're going to need to do. So how we project revenue here is we say, okay, how much has revenue grown in the past? And then we assume that it's going to grow by around an average of that same amount in the future. So to find that, we're just going to do equals. You can do open parentheses 2020 revenue minus 2019 revenue divided by 2019 revenue. So it's essentially ending minus beginning divided by beginning to see how much it's grown, 3.66%. And then do the same thing for 2021 to 2020, or 2020 to 2021, sorry about that. And then you can Control R that. And that's what you got. So now we have respective revenue growth of 3.66%, 1.42%, 6.48%, and 22.27% from 2020 to 2023. And now we're going to find an average of those, and that average is about 8.46. We can Control R that. And so that average right there of 8.46 until 2028 is the average revenue growth that we will use for this model. So we're going to assume that revenue grows at a constant 8.46% for the entirety of the period of this model. And so as we put these numbers in, we might see, okay, 8.46 might be a little unreasonable. 8.46 is a little high. So, you can maybe wean that number down. Sometimes I'll do this, wean that number down just to make it a little more conservative. Go from 8.46 to 7, 5, 3, 1%, right? Or 2%. So that's just a figure just to make sure that you're being more conservative, right? When you're doing evaluation, you want to make sure that you're more conservative than not, right? It falls into the thing of under promise and over deliver, right? So you really don't want to try to make a company seem better than it is and then invest in it and see, oh man, they really didn't grow by 8.46% every single year, so our assumptions were completely off, right? So that's why we're doing that. But again, these changes are somewhat subjective. You could change this to 5% for every year, right? It's sort of in your realm of discretion, and the more you research about a company, the more accurately you'll be able to project these revenue growths as well. So now how we're going to do this, how we're going to project this is for 2024, we're going to take that 2023 number from last year and then multiply it by 1 plus the growth rate for 2024. Then you get your number. And then you do the same thing through 2028, so you can just Control R that. Pretty easy, right? So now we have our revenue figures. So we can now complete step 2 of the model, which is going to be projecting net income as a percentage of revenue. So we have to find what percentage of revenue was net income in the past. So you can take 2020 and just simply do net income divided by revenue. and do that through 2023. So Control R that again. And then once we have those figures, about 24%, 39%, 29%, 31%. Now we have these figures. We can say, okay, they're pretty similar, around the same. It's probably going to be around 30-ish percent. So what if we assumed that it was, a constant average of these numbers through 2028, right? That's a pretty reasonable estimation. So we're just going to do average and then look at those four numbers. Do that. So you have about 31%. And we're just going to Control R that. So essentially what this shows us here, what these five numbers show us, is that for 2024 through 2028, you can assume that net income is going to make up about 31% of revenue. So to then find net income is pretty easy, right? You're just going to say equals revenue and then times the percentage that net income makes up of revenue, about 31%. And then you can just Control R that again. Pretty easy. And now we have revenue projected for each one of these years. So now we can move on to step 3, which is going to be where we are going to now calculate our capital asset pricing model. And so now we can move on to step 3. And step 3 is going to be where we calculate our capital asset pricing model, CAPM. So now you're going to go to your CAPM tab. And like I mentioned before, this is already filled out in this model just because I do not readily have access to the Bloomberg terminals where this information is typically gathered, right? So you typically gather this information by going to, a company. You just click on a company and going to the equity relative valuation function. So I believe it's EQRV. And when you pull that up, it should pull up, risk-free rate, expected market return. And, from those two, you can find your market risk premium, because essentially it's just the expected market return minus the risk-free rate. And then you can also find your beta using the beta function. And so that'll typically tell you. And I believe that the equity risk premium function also will tell you what the beta is at the moment. So it should give you a 5-year beta. But essentially what you're going to do in here is I will delete this out so you guys can see the actual the numbers and how the formula plays out. You're going to go equals and then take the risk-free rate. So that's the base of this formula, right? So you can take the risk-free rate plus your market risk premium, which is just the excess return that the market should give you above a risk-free product like a treasury bill or like a government bond or something like that, times then the beta, because the beta is the level of risk that the company endures, the level of systematic risk or general market risk that the company endures. So then that CAPM shouldn't say WACC, sorry for that. The CAPM should show you a required rate of return that the company should give you. So it's essentially a discount rate that we're going to use here. And again, all this will be covered in a lot more detail in the valuation guide. But that's essentially how you do it in the model itself. And then when you find that, you can put that in the D&I tab right under the growth rate and sum of PV of net income. So you just do equals, get out of the CAPM tab, and pull that there. So now you have that in there. And now for the fourth step. So we're going to be discounting the net income figures that we get and finding the present value of the future net incomes as well as the terminal value. So what we're going to do is in 2020 in the D&I tab, we're going to pull net income for 2020 from the net income projection tab. And then again, you can just Control R all the way across. It's 2020. And then now comes sort of a difficult part, but again, once you do this a couple times, it's not too bad. So in year one of the projection time frame, right, of the projection horizon, you're going to click equals and then use function PV. So find the present value, right? So your rate is the first thing it's going to give you. So now that rate is essentially just going to be the discount rate you're going to use. So we're going to want to use that CAPM. So you're just going to scroll over and click on CAPM. And a handy little trick that you can use too, you want to lock in this cell so this cell won't move. So when you Control R and move that formula over, typically every cell that's used in that formula would shift over as you shift the formula over. But if you want to lock in this cell so that it stays here no matter what, you can do FN F4. So function F4. And then it'll give you those dollar signs. And if you don't have the dollar, the F4 on your actual keyboard, then you can just manually input those dollar signs right in front of the C and right in front of the 12. And that'll do that for you. That way you don't have to just go back and forth and edit the formulas after you shift the formulas over. It just helps you out a lot, saves you a lot of time. And then number of periods is going to be 1. And because we want that formula to shift over, that cell to shift over as we move the formula, we're going to keep that. We're not going to lock that cell in. PMT is going to be 0. FV is, so you're going to want to start that FV with a negative, and then it's going to be that number up top there in 2024, in that current year. And again, we're not going to lock in that number. It's going to shift cells to 2025, 26, 27, 28 as we move the formula along. And you want to put the negative in front because essentially the future value and the present value in the formulas have to be opposite of one another. So if you put in a positive number, it's going to return a negative number, which is just going to make things very tricky. So I'm going to put in a negative there. And then the type, always click 0, end of period. And then you can Control R that. And there we have all of the present values of the future cash flows. And so now we can just sum these up and put them right here under the implied share price calculation. So you can do equals sum, use the sum function, and select all those. And then there you go. So the sum of the present value of future net income, it is about $233 trillion, essentially. And now for the terminal value. So the terminal value is where it can get a little bit tricky. So this is probably the hardest part when doing a valuation of any kind. And once you see it a couple times, it'll hopefully get a little easier. But essentially, what you're doing is saying, okay, if we were to project net income through all of time into infinity, not just this time frame, and then discount it back to this time period in 2028, what would that value be? So there's a lot of complex algebra and calculus that goes into calculating this formula, but there's something called the Gordon growth model that helps you calculate this terminal value. And so the formula gets covered in the valuation guide, so I'm not going to cover it too much here, but essentially this is what you're going to want to do. You're going to want to take the 2028 net income figure and then multiply it by 1 plus the growth rate. And so that right there will give you a next year figure for 2029, how much you think that net income is going to be in 2029. Again, that growth rate is just 2%. So it's going to be, that's just the constant growth rate of net income into infinity is what we're assuming. And that's based on the average GDP growth, essentially, and inflation. And then we're going to divide that by CAPM minus the constant growth rate. And again, I don't know the reasoning why this is the formula for it, but it is. There's a lot of complex math behind it. So if you guys are really good at math and want to figure out the reasoning for that, go right ahead. I'm sure there's some studies on it, but that's not the reasoning for this video today, so we're not going to hit on that too much. But now that we have this terminal value, we have to find the present value of that. So again, just use present value function and use the rate, the cap m, and then number of periods is going to be 5. So you can just use that 5 up there. And the payment again is 0, and then the future value is negative that number right there, and then 0 because it's the end of the period. And then got that. And then essentially the equity value is just summing up the present value of the terminal value plus the present value of the future net incomes. So that's essentially what we're going to be finding. And this leads us into step 5, which is going to be finding an implied share price and interpreting that said share price. So diluted shares outstanding. So you can find that in Excel, or you can find that within Bloomberg. You can also find that within Excel. So what we're going to be doing here is our company is JP Morgan. So I'm going to type in this cell, JPM. And then I'm going to go up to the top, click on data, and you can click on the stocks function when you have the cell selected. And then it should pull this up on the right where you can select JP Morgan Chase. Then it'll pull that up. And then on the shares outstanding, you can click equals and then select that cell with JP Morgan Chase. And then if you click a dot, just a period, it'll give you a lot of different options for what you can pull. So I want shares outstanding, so I'm going to pull shares outstanding, and then it'll give me that number. And so obviously this number is just raw, and the rest of our figures are going to be in millions. So I want to get this in millions. So I'm just going to say this 2,871.67. 2,871.67. Beautiful. And again, that number will be in Bloomberg as well. So if you guys have access to a Bloomberg terminal, that might be even more up to date. So I would typically lean on the side of using that instead of this, but this can be a handy tool if you don't have access to that. Then, of course, the implied share price is just going to be that equity value divided by the shares outstanding. That'll get you to implied share price of about $257.74. And I also went ahead and pulled the trading price from that Excel function, the Excel stock function, and calculated an implied upside or downside. And so there's about a 30% upside. So this is how you do the discounted net income. And as you can see, I have a sensitivity table here, with different constant growth rates and CAPMs. And so this essentially shows you the spread of as the CAPM changes and the growth rate changes, that's going to change your terminal value. That's going to change how heavily discounted your net income is, which is obviously going to change your implied share price down here, your bottom line of the valuation. So this right here is fully from scratch how you do a discounted net income. And so this is definitely the simpler of the two models we're going to cover today. So if you're having a little bit of trouble, reference back to that valuation guide. But with that being finished up, I'm going to go ahead and pull up the residual income model, and then we can go ahead and get started with that. So now we have the discounted residual income model pulled up, and you're going to begin by residual income tab down here. So it should be right next to the DRI tab and the CAPM tab. So some things just kind of right off the bat that you're probably going to notice is the similarity to the discounted net income model and the template that we worked with for that. And again, these models are going to be very, very similar. We're going to start out pretty much the same way. So with this one, the first step, again, is to pull the financials from Bloomberg, Yahoo Finance, whatever it might be. For the most part, for you guys who are going to be doing it within Bloomberg. So we have those financials pulled to the right of the sources tab. And so for this model, we are not only going to be needing the income statement, we're also going to be needing the balance sheet. So I have pulled both of those here. And then once we have that, we can pull net income. And so we're going to pull net income the exact same way that we pulled it for the discounted net income model. That's how we're going to start. And just kind of a heads up, again, you should have learned a little bit about this when you've been doing some reading inside the valuation guide. But again, the idea of this is that we're going to look at the residual income instead of net income, discount those future figures back to the present value to find the value, the equity value of this company. So again, in this case, we're still using JP Morgan as our case company here. And so just kind of high level, residual income is net income minus an equity charge, which you can find here in this second line of the model all the way across. And so the equity charge is essentially the opportunity cost of investing in this company's equity, in this company's stock. So intrinsically, it's going to be a much more conservative model than the discounted net income model. So now I'm going to get started pulling net income. It's going to be the first step. So again, we're going to go equals and then go down to the income statement, 2020, and you're going to want to pull net income. Net income, GAAP. That's again going to be the one we're going to look at. Same one as the discounted net income model. Then we can just select and then shift right arrow and then control R that all the way across. And then since we have that model here, what we're going to be doing is, again, we're going to have to project net income. So we're going to do that the exact same way as we did last time. So we're going to take, we're going to find revenue for 2020 through 2023, and then base our future projections of net income based on how much net income is as a percentage of revenue in the past. And so we're going to do here. I'm going to go pretty quickly through it since we did it for the last model. But again, focus on this, practice it. Once you do it a couple times, it becomes second nature. So pull revenue from the income statement. Pretty easy stuff here. Just go to 2020, net revenue, control R. And then we're going to want to get onto 2019 revenue, pull that there, find the growth rate from 2019 to 2020, which is just going to be 2020 minus 2019 divided by 2019. And then we're going to want to do 2021 minus 2020 divided by 2020. And then we can control shift, or we can shift right arrow and then control R that all the way across. And then boom, we got that there. And then now we can find an average of this. And about 8.46. So same thing we're going to kind of do last time. You go 8, 7, 5, 3, and then 2 to finish it off. That way, we're being a lot more conservative in our projected revenue growth. And that way, toward the end of our projection period, we're looking at about a 2% growth rate for revenue, which is a pretty fair estimate, pretty conservative estimate. We don't want to overestimate these things, like I mentioned before. So now we're going to use these growth rates in the future to project our future revenue. So we're going to take the 2023 figure, multiply by 1 plus growth rate for 2024. And then we're just going to control R that all the way across. So now we have those figures. And now we're going to take net income as a percentage of revenue. So again, this is exactly what we did for the last model. So I'm going to kind of quickly go through it. And then we can find an average of this like we did for the last one. And then lock in those cells so that when we shift this formula, it will keep the same number. And then so we're going to assume that net income makes up about 31% of revenue each year in our projection period of 2024 to 2028. So we can just take our revenue for 2024 and then multiply it by that 31%. And there we go. Now we have our net income projected. So that is the end of step 1. So going into step 2, we're now going to want to calculate our equity charge. So this equity charge is going to be obviously in the equity charge tab. So it's going to actually be fairly similar to what we've done in the last tab and projecting out a figure based on a percentage of another figure. So now instead of using income figures, we're going to want to use balance sheet figures. This is where the balance sheet comes in. Equity charge, what we're going to do is find essentially, like I said, the opportunity cost of investing in this company, essentially, this company's stock. So how do we find that? Well, we're going to have to use the capital asset pricing model, which if you guys have read the guides, know is the required return of a company's equity given its level of risk. It takes beta into consideration, which is market risk, and then also takes into account the risk-free rate of return found in like a treasury bill, and then also takes the market risk premium. And so each company typically is going to have a different capital asset pricing model, different CAPM. So that's expressed in a percentage form. We need it in a dollar form. So we're going to multiply that CAPM by the total amount of equity on a company's balance sheet, the book value of equity right there. And that's going to give us a dollar amount, the amount of equity total on a company's balance sheet. How much should it return each year? Well, you multiply that equity by the required rate of return, which is the CAPM. And in doing so, you'll get your equity charge. So we're going to begin by pulling book value from the company's balance sheet. So you don't want to go to 2020 and go below assets, below liabilities, and go to this total equity line item right here for 2020 and pull that. And then we can pull that over all the way through 2023 by, again, just using Shift, right arrow, and then Control R. And then now we have those actual figures from 2020 through 2023. Now, we're going to want to project this out through our projection period, 2028. So we're going to come down here, and instead of, like we did last time, we found the percentage that net income was out of revenue. Here, we're going to see how much book value was out of total assets. Because if you remember the accounting equation, it's just going to be assets equals liabilities plus stockholders' equity. So the assets, or the book value, is going to make up a certain proportion of the total assets. So now we need to pull assets. That is the next sort of sub-step in this. So go to the balance sheet, go up to total assets, and pull that for 2020. And we want to Control R that. And then, again, like we did last time, we're going to want to find the growth over each year for your assets to be able to project that into the future. So we're going to take 2019 assets and find out the asset growth from 2019 to 2020. So again, I'm going to move sort of quickly through this because it's really similar to what we did in the last model with the net income and the revenue. So you're just going to take 2020's assets minus 2019's divided by 2019's. And then you're going to take 2021 minus 2020 divided by 2020. You can just Shift, right arrow, Control R. And then you're going to want to take an average of those figures. And then we're also going to want to lock that. So we're going to make this a consistent number across all these projection periods. So we're going to assume assets grow by about 10% per year through our projection period. And so we're going to just take the 2023 number and multiply it by 1 plus that growth rate in 2024. And then Control R that all the way to the end. And now we have assets projected through 2028. So now we're going to have to figure out for the last 4 years how much, what percentage of assets has book value taken up. So to do that, again, very similar, just divide book value by assets. And then you can Control R that again. And then similarly to last time, we're going to want to take equals average and then lock in those numbers, again, using the F4 key. And then we get about 8.14. Control R that again. So we're assuming that book value makes up about 8.14% of assets. So that means about 92% of total assets are actually liabilities. And so we're going to use this figure to find the book value during our projection period. So we're going to go to 2024 for book value, and then take the total assets and multiply it by the percentage that book value makes up, 8.14%. And then again, you can just Control R that formula all the way over, and now we have our book value projected out. And now comes the next step, and it's slightly more difficult. It's going to be the third step, which is calculating your CAPM, capital asset pricing model. So for 2023, this is already done. We did this in the discounted net income model, but now, because we need one for each year, it's going to be slightly more difficult. So you're going to want to go to the designated CAPM tab here. So we have one for each of the actual years, and then each of the forecasted or estimated years in our projection period. So these numbers, as you can see, are already in there. These numbers are already in there just because I do not have access, again, to the Bloomberg terminals right now. But when you do that, you're going to want to pull these numbers from Bloomberg. So to find the risk-free rate, find the expected market return, those things obviously needed to find the market risk premium. You're going to want to go to type in a company. So in this case, you're going to want to go to JP Morgan, go there and go to company analysis. And then once you're in company analysis, you're going to want to click on equity risk premium. And that is going to get you to all of these figures. It should show you beta as well. If it doesn't, there's a designated beta function for each company as well. So you can go into that designated beta function, and you can change the dates of when that beta is being calculated, and then it'll give you different betas. So that's simply what I did here. Was very, very simple, didn't take very long, but now that we have that, we can calculate the CAPM for each year. So again, just sort of a refresher, just for this 1 year, I'll go through the formula again. So it's just going to be equals to the risk-free rate plus parentheses, plus the market risk premium times the beta, and that's going to give you that. So for 2020, it was about 9.74, 10.9 for 2021, 8.45 for 2022, and about 9.8 for 2023. So you can go back up into the equity charge, go to CAPM, and then click equals, and then go into the CAPM tab and pull these numbers for each one of the years. You can Control R across all of those tabs. And now that we have that, we can actually calculate our equity charge, which is the last thing needed in order to calculate residual value, so our residual income. So, like I said, we're just going to multiply the book value times our capital asset pricing model. And then we can Control R that all the way across. And now we have our equity charge. We can take this and put our equity charge into the model. So there, and again, just Control R all the way across. So again, I just went to the 2020 for equity charge, did equals, and then went back to the equity charge tab and pulled the equity charge for 2020, and then used Shift, right arrow, Control R, and that got all of those in there. And now we can find our residual income, which is just going to be equal to 2020's net income figure minus 2020's equity charge figure. And then you can Shift, right arrow, Control R for that as well, and you'll have all those figures. And now, if you ever forget, do you add or subtract or multiply these? The equity charge has that subtraction sign right next to it, just in case you forget. So you know, okay, I'm subtracting this out of this net income figure to find the residual income. And now comes the fourth step. We're getting toward the end, so we're going to come to the DRI tab. And one of the first things you can actually do to sort of set this up is just pull your CAPM. So go to cell C12, which is going to be the CAPM, and then go all the way up to CAPM, and then for the current year, which is going to be the one right before your projection period, it's cutoff line, you're going to pull that CAPM, which is going to be 9.8, and then we can go ahead and have that in there. And the fourth and final step is going to be finding the sum of the present value of future residual incomes and the terminal value. So to start, we need to pull the residual income for each one of these years in our projection period. So again, pretty simple. I'm just going to pull residual income from here and copy it across. And now we're going to use, similarly to what we did last time, the present value function. And so again, you're going to type PV, and then it's going to ask you for your rate. And so you're going to want to go to the CAPM, that's what you're discounting by. And then you're going to want to use that F4 key to lock in that cell. So when you shift the formula over, it won't shift this cell over with it. So you do that, and then you can select 1 for the number of periods right there. That's going to be the number of periods you're discounting this value by. And then for PMT, that's payment. That's payments over intervals of time between this time periods. Just going to be 0 for this. And then the absolute value of our future value is going to be negative this number, residual income for 2024. And then type is always going to be 0 for these. And then because we locked in that cell right here, we can just use shift right arrow and control R all the way over. And now we have the sum, fix this right here, sum of present values of future residual income. And so now, like it says, you can use the sum function. So you can do equals sum, and then select all of these figures right here, and then it'll sum them up. So it's going to be about 71,938, which in reality is going to be more like, this number is in millions, so it's going to be about 71 billion, 938 million. And now we're going to find our terminal value, because we're going to have to add the present value of our terminal value to that figure to find the equity value. And so to do this, again, we're going to have to use that Gordon growth model formula. So we're going to want to do equals, go up to 2028, and multiply that number by 1 plus the terminal growth rate of 2%. And the reason we're doing this is to find 2029 residual income and divide that by CAPM minus terminal growth rate. And again, if you guys read the analyst guide, this is essentially like a perpetuity. There's a lot more math behind it than that, but you don't really need to know the deep math behind it. You can if you want, but as long as you know the formula, know how to get there and what it tells you, how to interpret it, then that's all that matters. And there's some good resources in the guide as well to show you, sort of if you're more of a visual person, how to visualize this well. So this number we're going to get here. And so got that figure right there. And then now we're going to find the present value of that terminal value right there. So again, we're going to use the PV function. We're going to use the same rate, the capital asset pricing model, CAPM, and then number of periods is going to be, you're going to want to go all the way up here to 5, because the terminal value tells you essentially the present value in 2028 of every future residual income past that projection period. So we're going to have to discount it back from 2028 all the way to the present value. Where periods is 5, 0 for the PMT, future value is negative, and then use that terminal value, and then 0 for the type. And then you're going to get that. And then you're going to want to sum this figure and this figure. And so you're going to get equals this plus this. And that right there is essentially going to be your equity value. And so the final step is finding an implied share price and then interpreting said share price. So to do this, you're going to want to find the diluted shares outstanding. And so again, like we did last time, we can use this stock function in Excel to find the number of shares outstanding. You can also go into Bloomberg. The financial analysis function will help you find that. So we don't want to go here for our purposes today. And then once you have the cell selected, which in this case is D18 with that stock, you're going to want to click on dot or period, and then you can go to shares outstanding. And it'll give it to you. And so here we're going to want to put in millions. This is just the raw number, but you want to put in millions. So I'm just going to type it in. So it's going to be 2871.67 millions. And then you can just divide the equity value, which is essentially your market capitalization, divided by shares outstanding to get an implied market price. And as you can see here, it's much lower than the current trading price. And as we said earlier, this is a much more conservative figure. So it's not too much of a surprise that it's much lower than the trading price and has much more of a downside than the discounted net income model. So that's why you can't just look at one of these models in a vacuum. You have to look at them in unison and look at them in conjunction with one another. So at the end of the day, this is how you do a discounted residual income and a discounted net income model. If you guys have any more questions, let us know. But this is a very useful way to value financial services companies. So thank you.